And we are live. Hello, good morning, good afternoon, good evening, whatever time that you're tuning in to watch this. Greetings to you. Welcome back to another episode of Monday Morning Market Report, where we dive in into the Central Florida, Orlando, Florida real estate market and pulling up nuggets to make you a more informed investor. And we know that knowledge is power. The more that you're informed, the better your decision making will be and the more profitable your investment will be. So, without further ado, I'm your host, Joe, and joining me today is one and only Russ. Russ is a dear friend of mine. He is a colleague here with RPM Trusted Hands, and we're just super excited to delve more into this report. Russ, how are you doing this morning?
Fantastic, Joe. Great to see you. Great to talk to you. And it's a pleasure to be here to talk about this critical market report. I'm excited about it.
Absolutely. Well, thanks again, Russ. So we are really thrilled to not only have you here today, but the insight that you're going to, share with us as we dive into this report. So jumping right into it, the report mentions several things, but notably, not only are we halfway towards the year, the calendar year, but the Orlando market, the housing market, still remains relatively strong. And according to Lisa Hill, who is the president of the Orlando Regional Realtor Association, June's housing data is only showing that the rest of the year will also follow suit, right? So it's a strong market now, and if trends remain, that it is going to be a strong rest of the year as well. So we can expect more inventory, and not only more inventory, but the prices for the homes to also remain relatively high, which is good news for sellers and buyers, right? Right, Russ?
That's correct, Joe. Yeah, the market is really showing quite resilience, which is pretty surprising given all the headwinds that it continues to face. We're seeing sales go up. We're seeing prices go up. Those are strong indicators in such heavy headwinds. And when I say headwinds, I'm talking about interest rates. The interest rates in the attempt to slow down the economy. Raising of interest rates is definitely created an impact on the entire economy. But in terms of the Orlando market, it seems to continue to be able to hold strong, at least plateauing in terms of pricing.
Yeah, that's really interesting. And what we're seeing from this report is that the median home price for June 23 was 385K. And that's significant because we're seeing an increase of $7,000 since May 2023. So June 2023, 385K being the average price, where in May was 378. And it's interesting to note that the price for the home has relatively increased each month. And we're only within what $2,000 of a difference between where we were last year in June 2022.
Right.
That's remarkable, isn't it?
It really is, and you know what? The interest again, when you hear a lot of the news and reports on the economy, you hear kind of a doom and gloom type of scenario. But what we're seeing really here in the Orlando market is we've seen stability in prices. We've seen a plateauing of the market overall, and that's a really good sign. I mean, I think many of the market economists, when they're talking about the Orlando market, they're talking about a market that is, yes, showing some signs that we might see some weakness in the future. And when I'm talking about that, I'm talking about the increases of inventory. But yeah, overall, we're definitely seeing stability in this market. We're seeing a plateauing of prices. We're seeing, a lot of people were talking about how we're going to see this kind of crash effect, and we really have not. It's doing, if anything, it's just continuing to strengthen at these price levels. And when you see it not only going stable, but actually moving up, I mean, those are really positive signs. Especially, like I said, in the way of these headwinds.
Yeah, no, that's really noteworthy. You're seeing how stable and seeing that increase as you just mentioned. So right now we're seeing that the home prices are increasing, and there was an overall sales drop. I mean, a very insignificant, in
Right.
my opinion, a very insignificant number, less than 1%. We're looking at 0.8% drop from May. And when you're looking at numbers, I mean, May, the sales, overall sales, the number was 3,150 compared to 3,124. So we're looking at what is that a 26 less homes sold in June compared to May.
Right. I mean, you're talking about really such a small drop. I mean, that could be so many. That could be environmental factors. That could be, that's could be seasonal factors. It's such a nominal drop. We should say that it's almost the same. It's
Mhm.
it's a real, what we're seeing, and I'm kind of saying it over and over again, but this plateauing, this plateauing of the market is a good indicator, because typically markets will adjust, either continue to trend higher or reach a barrier and dip. What we're seeing, and this is I think a really positive indicator, is we're seeing a market that rised and it has risen, and then we see it plateau rather than dip.
Mhm.
That's an important just in terms of signs of strength and signs of weaknesses for future. It's definitely a great sign of future positive growth and strength. I mean, the fact that we aren't seeing dips, instead we're seeing plateauing, is a really good indicator that we should continue to see this type of trend going upward.
Yeah. So, Russ, let's talk about another indicator, which is inventory. So, looking at June, we're seeing like continuous increase in the level of inventory. So, in June, there were about 5,450 homes on the market, which represents almost a 6% increase from May. So, and where the inventory was recorded like a 5,000, nearing the
Right.
5,150.
Right.
And when we compare that to June 2022, we're still seeing an increase. Where, I mean, although it's a small increase, but we're seeing about a 0.2% increase in the level of inventory compared to 1 year ago.
And absolutely, that is probably one of the most important economic indicators that we're seeing coming out of this report, that may give an indication that of slowing and increases in prices, is because you know inventory is strictly a measure of supply. And when you're talking about the prices are driven off of supply and demand. Absolutely.
Hmm.
And
Yeah.
those are real metrics. And inventory is the measure of supply. And so when you have um, uh, increases of houses coming on the market and a decrease in pending sales, what you're seeing is a larger inventory on the market, which, that's a good thing for buyers. For buyers, they've had a tough time. I mean, it's still surprisingly, in Orlando, it's one of the few places in the country where you still have a seller's market. And so for a buyer coming into this market, it's a welcome surprise to see this inventory actually pick up a little bit. But still, it is, in all indicators, we're still in a seller's market here in Orlando, which is, that's quite a surprise compared to perhaps other places in the country. So these increases in inventory are signs that these prices going up are going to slow, but it's not such a big increase in inventory that you would say, oh, we're going to see a crash in the market, right? We're, if anything, going to see that plateauing, right?
Yeah.
That we might as well title this the plateauing of prices in Orlando, because that's
Yeah.
really what I think is the true message of this report.
Yeah. And which, I mean, I think that's really important to know, especially for those who are thinking about investing,
Hmm.
in that maybe you're thinking, I'm going to wait for when the market dips. Well, it seems like you said it's a plateau. So we may not be seeing that dip as expected or as predicted. I think all the major outlets or the experts, they were seeing this doom and gloom type of
Right.
where we'll be at today, and that's not what we're seeing. So um, today's better than waiting and seeing what's going to happen. I think
Absolutely.
I'm no economist or
All right.
or
Uh,
financial advisor, but just looking at these numbers, that's I mean, am I on the right track there?
Absolutely. I mean, you're 100% on. What instead of trying to predict the next dip and try to take advantage of the next dip, which is easier said than done, because when you have a dip, it's usually some sort of negative economic indicator that's caused it, and it causes fear, right? A lot of people have a tough time buying in the face of fear. So, I really what people should do is they should look at their investment portfolio and decide, is this right for their investment portfolio, rather than trying to buy dips and try to time the market. The real reality is that you really just need to look at what your risk profile is, and do you feel comfortable getting increasing the amount of exposure that you have in the market in order to increase your return. That's what the bottom line should really be. And when you start looking at these interest rates, I mean, you know, an increase, I mean, just think about this. These might seem small numbers, but when you go from a 5.5% interest rate to a 6.7% interest rate, and it even actually peaked out in July all the way up to 6.9. A 6.9% interest rate from a 5.5% interest rate, that may seem small, 1.4% increase, but when you go from a
Small.
5.5 to a 1.4% increase, that's almost a 20% increase
Yeah,
in interest rates. That's
yeah,
huge in 1 year,
it's
huge.
significant.
And so, when you start seeing those types of numbers, it typically, if you saw that in any other market, you would see almost a catastrophic drop in prices. And the fact that this market has still been able to hold up in the face of such a strong um, headwind is really quite amazing. So that in itself is very significant, and I think that when you start looking at that, and it still becomes a valuable opportunity, then that's the type of decision that you need to make based off of this current market.
Yeah, no, I think that was going to be kind of my next thought, and how the interest rates, I mean, they have a significant role to play to all of this, and I think contributing to a lot of the predictions of
Hmm.
that, seeing, and the market in the real estate industry declining, but
Hmm.
surprisingly holding strong
Right.
and holding stable. So that's really remarkable to know. And we all know that with each percentage, I mean, you're looking at a couple $1,000s more expensive of a home to buy.
Right.
But I guess if we're predicting anything, I don't think we're seeing any time soon for the interest rates to go down. So,
Right.
um, you know, again, looking into that crystal ball and trying to determine when you're going to jump into. I mean, I think
Right.
cast all that to the side and just look at your portfolio and see, okay, does it make sense right now, and what makes sense to invest into right now. And
Hmm.
I think that will pay, a lot of dividends in the future. So, lastly, Russ, before we close here, and thank you to everyone for hanging with us so far. If you have any questions, anything that stands out, that's interesting, or you want us to dig more into, please don't hesitate to comment below, or send us an email. Just we'll love to engage with you and to share, more of what we're seeing. So let's talk about new listings, which I think is also a significant indicator of where the market is.
Hmm.
Looking at May, so compare May to June, we saw a 7.1% of increase, with 3,703 new listings in June compared to the 3,459 in May. What more can you say about that, Russ?
Well, two things, two significant points about that. One is that typically you would look at that as, because that's an actual increase of supply, right? So typically you would say that that would be something that would be an indicator of a drop in prices. But in this case, what it is an indicator of people willing to get back into the market, people getting willing to get back into selling and buying houses. Because when a lot of people, some of the indicators we were seeing prior to this were indicators of people wanting to just hold back and basically hold on either buying or selling. You know, there was uncertainty, and because of that uncertainty, they didn't want to get involved in the market. Now what you're seeing is people being willing to list their houses and list their get back into the market. And what that does is, even though that is an increase in supply, in this case, it is an increase in supply, but more importantly, it's an indicator of people wanting to get back involved in the market. I think that's a positive economic indicator than what would typically be considered a negative indicator, meaning an increase in supply market. So I think that's another good sign there, especially, you know, that new norm of interest rates is starting to, the market's starting to accept it. And that's a good sign right there. In particular, and I'll give you one more point to that. In the month of July, I mean, this report that we're talking about is June. And so as these reports come out, we're looking back at what happened in the prior month and extrapolating the information. During the month of July, what we saw is, like I said, we saw interest rates spike up to 7.9% when the Fed was talking about increasing rates again. And as that softened, what did we see? We saw interest rates drop back down again, 7.8, 7.7. So what we're seeing is that the market wants to settle down in terms of interest rates as soon as the Fed stops. You know, as soon as the Fed decides that inflation is enough under control that it doesn't need to continue to raise rates. And so that is a good sign for the market, for healthy growth. And so, you know, that's one of the things that we saw during the month of July is we're starting to see, again, that spike of interest rates, but hopefully we've seen the top of the interest rates. I mean, 7.9, I mean, we're almost back to 8% interest rates. Considering we were just at 3% not that long ago, 8% is just an amazing number.
Yeah, it is. And I guess, you know, maybe this would be another conversation for another day, but historically looking, you know, how significant is 8% compared to some of those really, really high percentage, you know, periods of times where we had significantly higher interest rates. But yeah, that is remarkable. And Russ, as always, I learn something new every time we have a conversation. I appreciate you taking the time to break this down and into digestible bits. And I think that's all we are. I mean, everyone is so busy, so many things that are pulling for your attention, but being able to consume information in bite-sized increments and taking that in and applying it to your overall strategy. That's what we're here to do. So as always, thank you for tuning in. Thank you for spending your part of your morning with us. Share this with someone else. If there is an investor that you're working with, or maybe a real estate agent that, you know, could benefit from this, you know, this information, share that with them. Don't hoard news for yourself. You know, sharing is caring.
That's right. Fantastic, Joe. Thank you so much.
Absolutely. Have a great day.
You too.